Hi everyone, it's Ola Sulaimon here. I'm not sure about the lightning, I can see it very well. Yes, it's Friday again. The week has gone so quickly. Thanks for joining me today. It's a very sunny day out there, to be fair. Today we're going to be talking about pensions. And you'll be wondering, why should I worry myself about pension? Today I'll be talking about the tax consequence of pension, how to make sure that you save towards the future properly without having a problem or something in future. However, first of all, I'd like to talk about myself. So I'd like to introduce myself. My name is Ola Sulaimon. I'm an accountant and a tax advisor. I'm a qualified chartered accountant. I've run my own business for the past 6 years, and I work with small businesses and individuals, advising them with their accounting and their tax works. So because of this, I've heard different stories several times. So the reason why I do this is most people, they'll do the right thing if they know if it's the right thing to do. And most people don't know what to do. So usually, and that's the reason why I started this. Now, today, but usually in this live show, I usually talk about myself for some minutes, and then I'll go on to talk about the real tax talk. So today, the past 1 week has been okay, to be fair. There's nothing, trying to adjust the lightning because it keeps going up and down. So excuse me, Instagram, I think Facebook is okay. So I've continued with the swimming lessons and everything is going on fine. I'm getting ready, and I was actually thinking about it yesterday when I was doing my practice. Like, I've gone from not even able to even do anything at all, and now at least I'm wiggling my legs somehow. I'm still learning the breaststrokes or something. However, today when I went to town before coming to work, I think, and that's the main story for today now. So I got to the park and I just parked the car, and I realized I didn't have my bank card with me, and I was like, oh, okay, thank God for NatWest. I don't know, I'm not doing adverts for NatWest with that. Thank God for NatWest. I'll just click and get cash. And I got the cash. I was trying to get what I was supposed to get. I got to the first shop, bought what I needed to buy. Then got into the next shop. I couldn't find my money again. I dropped money. And that actually pained me a lot. I was just like, oh my God. Oh, that's why I don't carry cash. That's why I like carrying card about. I know it was like a lot of money, but it was really very painful. Like just dropping money on the floor. Money that you've worked very hard for. Anyway, so as any of us had that kind of experience, how annoying it is, it can be very annoying. So I'm going to go into the proper pension talk then. But before I go, I actually have an announcement I'll be making next week. I'm looking forward to that. I just want to make sure that everything is in properly before I go on announcing. And however, I wanted to ask this like a favor. If you have a group and you need someone to come and talk about tax or about their businesses, you can send the message to my email. I'll get back to you, because I'm looking for ways of just talking more about tax, probably because I love tax too much. So let's go into proper tax talk, because today we're going to be talking about pension. And yesterday when I was getting ready for this, I was like, oh my God, how am I supposed to talk about this in 30 minutes? Because it's a lot, it's massive. And all I just need you to remember is this is just to give you an awareness. This is not like if you need proper advice, I can't even advise you in financial wise, like this is a pension to go to. You need to find a pension person, a financial, this lighting, the sun keeps going up and down. You need to get somebody that is a financial, what do they call them now, that provides pension. I'm not allowed to advise you to go for one pension or the other. However, this talk is to talk about tax consequence. Sorry, I'm just going to ask for 1 minute because this one keeps going up and down. Anyway, so today I'll be talking about the tax consequence of having pension rather than choosing pension, so that you have a better understanding about pension. Now, if you're watching now, probably because, hello, because you're at home, I think we need to advise our friends to watch this later if they're thinking of pensions or anything, I usually upload this video on the YouTube or put it on the Facebook for like 3 or 4 days, because education is very, very important. At the end of the day, somebody's losing money, and it's not nice to lose money. Like I lost my money this morning. So pension is like a retirement plan, a plan for the future, putting something extra aside. I think it was about 2 weeks ago that this app came up about Face app, what you'd look like in future. And I have to say, when I kept seeing everybody doing this, I was like, oh God, I don't really want to see what I look like in future. But I did it in the end. I was like, oh my God. So because of that, there'll be a time that I won't be able to work as much as we have now. I know times are changing. People are getting older and older, and so maybe we shouldn't worry too much, but still, we're still going to get older. We're still going to get old. We're still going to feel not as strong as we are now. So pension is like putting something aside for the future. Now, last week I talked about state pension. State pension, so I'll start from there. So I've divided into 3 kind of to be able to explain very well. Now, state pension is the money you would receive in future from the government. And that's because you've actually contributed your national insurance. I spoke in length about national insurance last week. And if you missed that, the video is on my YouTube. You can watch it, runs as accountant. You can watch it, that will explain more. So whatever you've contributed or your employer has contributed for you with your national insurance will determine how much state pension you can receive. I even went on last week to talk about that at some point you can actually check how much you have in your pension, state pension pot right now. You can go on HMRC. I'd add the link, but I was going to write it down, but I didn't write it down. Anyway, so you can go and check how much you're going to be paid weekly in future. Now, another question that people ask is, that state pension, would you be taxed? Yes. It's going to be like a normal, I don't even know why we just went for yes. No. So it can be yes or no. The reason is because it's going to be like a normal income that is going to be paid to you. So let's say you have rental income somewhere else, you have capital gain tax, you have capital gain income or different other income. As soon as you go over your threshold in that year that you start receiving pension, then you pay tax on it. So for example, if your state pension in a year is 12,500 this year. So if you don't have any other income elsewhere, you will not be paying tax on that state pension. However, let's say you're receiving rental income of 10,000 or other incomes, then you would have to pay tax somewhere because you're still receiving income. It's going to be treated as if you've received income. So it is taxed, depends on how much you're earning. But the main other one, so let's say then you've gone to check your pension, state pension, and you'd be like, oh my God, I haven't got much in future. There is still hope. There are 2 other main ways of having pension in future. So the first one is your personal pension scheme or the occupational pension scheme. I'll start with the occupational pension scheme because that's kind of more common than the state pension one. So the occupational pension scheme is the one that is provided by the employer. On that one, there are 3 different ones, and I will explain that quickly. So basically, the employer will set up a scheme, and they will put money into it, and then they will pay you that money. But let me explain the 3 different ones. So there's a defined benefit scheme. And under this defined benefit scheme, the employer would promise you that when you're going to retire, we're going to pay you so amount of money. It doesn't matter how the company is doing, then they are just going to give you that money. And it's usually based on your final salary at that year that you're leaving. So because of that, as soon as the employer promises that kind of money, they'll make sure that they have enough money in place to make sure they will be able to provide that promise. Now I have to say this is not common these days because things are changing, so I think a lot of people are more conscious of not doing that. So I don't think they have loads of new people going into the defined benefit system. However, for those that are already in it, they're probably still leaving them in it. Okay, I'll go to the other one, which is the defined contribution. That's the most common one. And I think the reason why it even became more common is because of auto enrollment. If you're in UK and you watch TV or listen to radio, I'm sure you'll have watched the advert of your employee pay, we pay, or something like that. So when auto enrollment came in place, it literally almost threw combined the benefits system out of the way, because now more employers had to do it, not because they want this, but they are doing it out of their kind nature. Is the law, they had to do it. So under defined contribution system, the employer will make contribution to your pension pot regularly. So just like the other one now, they'll set up a scheme for you and they will contribute into it from time to time. And then it's not just your employer, you yourself, you contribute. So it's both of you contributing at the same time. So if it's the one that is not under the auto enrollment, both of you will make an arrangement of the percentage. So your employer will say, I'll be dropping 2%, you'll be dropping 3%. And that money will then be dropped in a pension pot. Now, the only difference, the major difference between the two of them is, the first one, the employer has promised you that no matter what happens to the pot or anything, you're definitely going to be getting £1,000 every month at retirement. Meanwhile, with this other one, depends on how much the pot does. Depends on the pension provider. Depends on because what the pension provider then do is they then go and put it into some schemes and then try to get money out of it. So it depends on how much your pension is doing. That's what will determine what you'd get at the end. So that's the major one. The third one is the hybrid type, and that hybrid has the both features of both the defined one and the contribution one and the defined benefit one. So, however, that's just me introducing the type of pension we have. Now, for auto enrollment, so in I think it was 2016, I can't remember exactly when. So HMRC or the government now noticed that a lot of employers were not paying pensions to their employees. And also a lot of employees too were not worried about their pension. They don't even care if they get something in future or not. So because of this now, they did something that made employers to actually pay their employees pension, whether they like it or not. So as soon as an employer qualifies for pension, then their employers had to roll them in auto enrollment. Now the employee now have the right to say, no, I don't care about the future, I want my money now, don't deduct my money. However, the employer first has to enroll them first, and then the employee would then opt out and say, no, I don't want to talk about pension. But usually most people, they just stay in the pension. I think that's what the government was trying to do. They wanted people to be encouraged enough to drop some of their money at the moment. And usually at times it looks a lot, because it depends on how much you're earning. So for this year now, every employee that's under auto enrollment have to contribute 8%. So their employer will contribute 3% while they themselves contribute 5%. Now you'll be saying, what percentage, what was this applied on? Now this percentage is applied on your qualifying pension, qualifying earnings. And your qualifying earnings does not necessarily mean what you're earning. So what they do is there's a way we calculate the qualifying earning based on the what's it called, the bar. So for this year, your qualifying earning will be anything you earn over 6,136 if you're yearly paid. If you're monthly paid, anything you earn over 512, and anything you earn over 118 for people that are paid weekly. And then the amounts will be deducted. Your employer will take the money and pay it into that pension scheme, and then you don't get that pension till later on. Now, for the the personal pension scheme, this is the other way of putting money into your pension scheme. So this one depends, that'll be you going to look for some private pension provider and saying, oh, I want to put money into my pension, and then you put some money regularly into that pension pot. So it's not your employer that is setting this up. At times some employer actually do, but it's usually you yourself actually setting it up yourself, and it can be a stakeholder pension one or a self-investment one. And both of them, both the occupational pension scheme and the personal pension scheme, they both have the different tax consequence. So this show is talking about the tax consequence of pension scheme. but I just had to introduce what pension is all about so that you have an idea. This video is actually not just the live, people are actually going to watch it later on, so I need to explain so that people would understand what I'm actually trying to explain. And I keep looking into the book so that I don't forget what I plan to talk about today. Then the question is, for those of us that do not have pension, or for those of us that have pension, you'd be like, so why do I want to have pension? Why do I want to worry myself about pension? I want to worry myself about today rather than tomorrow. And I hear that a lot. You'd be surprised how many times people tell me like, oh, forget about tomorrow, I will worry about today, which is right, kind of, but still, we still need to worry about future. So the advantage for you having pension right now is because every time you contribute into a pension scheme, you get tax relief from the HMRC. It's either you get it as source or as a net pay, and I'll explain that in a minute. So for example, before you can get that relief, you have to actually, because a lot of people earn different amounts of money, HMRC understand that some would enjoy more relief than the other one. So because of that, the highest amount of pension tax relief you can get is minimum of £3,600, or the 100% of what you've earned, your relevant earning income. And your relevant earning income will be your salary, your benefits, all the money you receive from your employer or from your trading, from profits, everything all added up together. Now, because there's tax relief with pension, a lot of people will want to put more into pension, and that's why they keep HMRC or the revenue to keep putting things in place just to make sure that people are not manipulating the system and getting more than they should be getting. So now your relevant income, I talked about that, from £3,600 to your highest income. So if my highest income, my relevant income in a year is 30,000, I can only enjoy tax relief for 30,000. So what happens if I'm earning 100,000? So because of that, HMRC wants to make sure that there's a limit of how much we can enjoy, and I'll get to that in a minute as well. Now, for the occupational pension, most likely you're going to be under a net pay arrangement, because I'm sure you'll be thinking, oh, but I don't enjoy any tax relief. Yes, you do. And the reason is, the way it works is, before your money that you've earned pass through that you're supposed to pay tax on, the payroll or your employer would first of all deduct the amount you've contributed for pension, and then you then pay tax on the remaining. So explain that with an example now. So let's say you earn £1,000. Forget about anything I've talked about, personal allowance or anything. Let's assume that £1,000 is due for tax at 20%. So that £1,000, you're supposed to pay tax at 1,000 times 20%, and then you should be paying tax of £200. However, now what your employer will do, so let's say your pension is £50. So what your employer will do is, they will take out the £50 from the £1,000, and then you then pay 20% of £950 rather than 20% of £1,000, and therefore you're paying less tax than you should be paying. I did the calculation yesterday. So instead of paying tax of £200, you'll be paying tax of £190. So that's the first tax relief. Immediately you're putting the money in, you're paying less tax. So let's say you now decide that the £1,000 your employer is giving you, you're just going to put it somewhere. You definitely pay the £200. I know you say £10, but that's just an example. For people that earn a lot of money, the difference is usually a lot. So because of that, you enjoy that tax relief under net pay arrangement. However, if it's a private, if it's a personal pension, then when you submit in the self-assessment or not, you can then go and claim the 20% of the net pay arrangement. So usually what we do is, when you're doing your self-assessment and you pay pension, you put the amount in. So the minimum relief you'd enjoy at that point is 20%. And then even if you're a higher earner means you're paying 40% or 45% tax, then you even receiving more refunds back. Now, the second tax relief is when you receive that money. And I think before I talk, okay, all right, I'll talk about the second. I think I should talk about that first, but Okay, I'll come to that. Now, the second tax relief is when you're 55 years old, you're allowed to take money out of your pension pot. Unlike the state pension that you have to wait till 65, your pension pot, you can take money out when you're 55. Now, in the olden days, I said olden days, like 3 years ago or thereabouts, you would be allowed to take 25% out of that pension pot tax-free. So let's say you have 100,000 in your pension pot because you've been very good. You take £25,000 tax-free. And then the other one, then your pension provider will be paying you gradually every year, and then you'll be paying tax on whatever is left. It will be treated as if it's your normal income. And you even get P60 at times, or summary at the end of the tax year of what you've paid or not paid. So because of that, I bet in the olden days, a lot of people used to put a lot of money in their pension pot so that they can get loads of 25% at the end. So because of that, so that's the second tax relief. However, last year it changed. That's the last year, I think about 2 years ago. And 2 years ago, what's happened is you can decide you have different options with your pension pot. You can decide to actually take the 25% and then leave the 75% there and be taking it down gradually. Or you can decide to take everything. Now, the disadvantage of that is if you decide to take everything out, or you say 25% tax-free and I'll take 75%, like I gave the other example, if it was 100,000, that means then you're paying a lot of tax in that tax year for that 75,000. Even though you're allowed to take the whole money out at once, the tax consequence is very high. So except if you really need that money, it's not really the best tax way to go about your pension pot. And then the second one is you can take some out and then put the money in another pension pot, and then take the money gradually down from that one. And so the first one is either you get a guaranteed amount from, or another one you can just get regular adjustable income from. Like I said earlier on, I can't really advise you on the pension plan you need to go to. You need to definitely get someone to advise you properly, because everybody's situation is different. And I say this all the time. So because of that, if you're thinking, oh God, the light bulb moment have happened, I need to have a pension, then you need to get proper help. Okay? Now, the other part that HMRC I talked about is, because you're getting 25% back, I really need to start checking my time myself. Because you're getting 25% back, HMRC knows that a lot of people have access to money, and they might not decide then to go and put loads of money in their pension. So what they've done is, every year you have a certain amount that you can receive tax relief on. Okay? So for the past 3-4 years, it's been £40,000. So literally, you can't enjoy tax relief in a tax year for more than £40,000. So immediately you put more than £40,000 in a pension plan, you can't enjoy the tax relief again. What you could then do is, let's say things change in your life and you've been in the pension pot for a long time, and then you then decide that, okay, I've not been putting money in my pension pot. What then happens is, even though you put 40,000 in that pension pot, you can then go on, as long as you've been in that pension plan in the last 3 years, you can enjoy some of the relief from last year or last 3 years. Basically, that's what I'm trying to say. So let's say you win a lottery, £100,000. And then you've been in the pension plan for the past 3 years. You've got 10,000 one year because you're very good. You've got 10,000 another year because you're very good. Now that you have access to all this money, you'll be like, I want to put more money in my pension. Because you've been in that pension scheme for the past 3 years, and you're not allowed to do more than 40,000 this tax year, you can go back then and then enjoy the 3 years before, and then still enjoy the tax relief. What they're just trying to do is to make sure that nobody is abusing the system because they've got money and enjoying too much tax relief. So 40,000, as soon as you go over 40,000, you can't enjoy any tax relief again. Also, if you're earning a lot of income from 110,000 in a year to 150,000 in a year, they introduced something in 2016-17. Then you start losing the pension allowance that you can get, and then you start paying tax back on that as well. So it still comes to the fact that they're trying to make sure that it's a fair system, but we all know that there's nothing that is called fair system. So because of that, for pension, I'll say, because I have 5 more minutes, I'll say for pension, for me, if you don't really have any plan in future, like let's say if you don't have like a, I know this is how do I put it down? This is just my judgment. This is just Ola just saying random things, unsolicited advice. If you don't have like a property somewhere, because a lot of people have loads of properties that they can sell in future and then they can make that into their pension plan. Because what happens is this money that you put into this pension pot is going to be invested by somebody, and whatever comes out of that investment, so it's either it goes up or it goes down. That's why you need to be very, very careful the pension plan that you go for. And as soon as you go into it, and I think the same report every year into that is not really working, it's definitely advisable to probably look for something else to go into. Because at the end of the day, imagine saving money for 20-25 years, and then you get to that age 55. Obviously, you enjoy that 25%, and then the 75 will then be drawn down for you yearly. Although there's different options now. I think they've reformed pension in such a way to give us more control about our pension pot. So if you're turning 55 very soon, rather than just saying, I'll just take that 25 and spend it, I think it's worth it looking at your options, getting advice, putting it in a proper pension plan, or if you don't mind paying tax, getting out the money and investing it into something. You never know how that would help or not. I know I've rambled a lot today and I've spoken a lot of things, but the purpose of this is just to help you to have a light bulb moment and think about pension. And the last 3 weeks I've talked a lot about personal tax. And I think next week I'm going to be talking more about, I'm just definitely going to look for a topic that will talk about business. But I still have time to think about what I'll be talking about business next week. Anyway, in the meantime, I'd like to say thank you for watching. Thank you for joining, and I hope you've learned one thing. That's all I say. Just one thing out of this video. You've had a light bulb moment. You're planning for future now because you watched Ola today during the lunch show. And I hope you'll be joining me next week. I know I have 3 more minutes so I can still talk. Thank you so much for joining me today. And I hope next week you'll be joining me as well. And if you missed it, you can definitely go on my Facebook, which is Aaron's Accountant, or it will be on the history if you're watching on the Instagram, or if you want to join me on the YouTube, you can watch it on the YouTube as well. I hope you have a very lovely weekend. I don't know if it's going to be sunny or raining, but greetings here from my office here at Ron's Accountant. Thank you so much. I wish you a very good, lovely weekend. Thank you. This time when I find somewhere to switch off, I'll do it. Okay, finish here. Finish.